Your world at 10. Now, the government has released the new direct tax code, a draft version for public distribution and comment. Joining us to discuss the salient features of what will create a completely new legislative for taxes in this country, direct taxes that is. I have with me Dinesh Kanabar of PricewaterhouseCoopers and tax advocate Porus Kaka. Mr. Kanabar, Porus, thank you very much for joining me. I'd like to keep it simple for our viewers to try and understand the scope and scale of this new direct tax code and how it's likely to replace the IT Act altogether. So if you can start off, Mr. Kanabar, by listing for me what you consider are the salient features or big changes that this code brings in, both from the perspective of corporation tax or corporate taxation rather, and individual taxation.
I think a very sea change, Menka. It's really not a rehash of the earlier act, and in that sense, the finance minister was right when he said that don't put the two legislations and start comparing them. It's a complete rewrite. More important, while the heads of income under which income is computed has been kept as consistent, if you look at how the provisions are written up, it's very, very different. More important and substantive, just coming back to corporates, one is the rate of taxes, which are indicative, of course, they have to be passed by the parliament and therefore would be relevant for the succeeding year. But the rates of taxes have come down very, very significantly. The threshold limits have gone up very, very significantly. In respect of corporates, a 25% rate of tax is indeed comparable with the global rates of taxes. And very interestingly, this is a single rate of tax applicable both to domestic corporations as well as foreign corporations. Coupled with that is a 15% dividend distribution tax which domestic companies would pay, and a 15% tax on branch profits which a foreign company operating in India would pay. Also, there is an exhaustive listing of several deductions which are available and certain items which are not tax deductible. There are certain changes which are likely to overturn the way we have been used to reading the law. So, for example, we have this famous theory of no cost, no capital gains tax if an asset has cost nothing. There are some court cases which have been overturned. But more important and very substantive is the anti-avoidance measures. And I can put that in two baskets. One is the general anti-avoidance measures which have been introduced under this direct tax code, where if a transaction is not regarded as a bona fide transaction, the tax authorities can rewrite the transaction and look at the substance of the transaction rather than the form of the transaction. And there are a series of transactions which have been listed, including sale and lease back, dealings between associated enterprises. And I believe that some of these can come in for intense scrutiny going forward. So if, for example, a tax officer believes that a transaction is leading to a reduction of taxable income, then he can go into it and see whether it was entered prima facie for the purpose of avoidance of tax. And finally, a series of changes in non-resident taxation, where it is provided now that the tax treaties will not override the domestic law. Both will have parity, and the fact that one is a law and one is a treaty will not make any difference. The one which has come at a later point of time is one which will prevail. Very, very substantive changes, Benka.
All right, Porus, what would you like to add to that list? If you could also give us a little bit more detail on how the capital gains taxation regime changes. And finally, a word in on whether this means this new tax code leaves less scope for litigation or not.
Well, I think on the last thing I must say, firstly, the process is exceptional. They've taken 4 years to come out with it. They want us, our comments, they are going to wait for another 3 years. So I think the government must be complimented on the process. As far as the specific changes, I think one of the major changes in capital gains seems to be the removal of the distinction or the differential treatment of short-term, long-term, except for the fact that you are continuing to get indexation in the long-term capital gains. There's a very high, now the option of substitution of cost goes up right from 81 to 2000. On the corporate sector, one of the significant changes is the concept of residence of companies, wherein any controller management in India could make a company resident in India. This is an extremely far-reaching amendment, and this is a policy issue whether, for example, simply holding of a board meeting may give rise to significant complications for a company, because once you become resident, you become taxable on your world income. So this is one of the important things. Of course, we have advanced pricing arrangements. We have provisions which now specifically say there is no double taxation in that. So those are salutary provisions. What I would have liked to see perhaps is the full taxation of agriculture.
Boris, hold on to that thought of what you would have liked to see. I'll come to that question in just a bit, but there are two issues that I would like more detailed comment from both of you, and that is this capital gains regime. Can you explain to me, Mr. Kanabar, so they've done away with short-term and long-term capital gains. Will there now be a capital gains tax irrespective of whether it's a 1-year applicability or 10 years applicability?
That's right, except that, as Porus explained, that if an asset is held beyond the period, then it becomes a long-term gain, and then you are entitled to indexation as opposed to short-term where there is no indexation. There is also a further change there, that earlier you had a deemed short-term capital gains tax. If you sold a business asset from out of your block, and the block turned positive as a result of the sale consideration, then the difference was regarded as short-term capital gains. Now that would be regarded as business income. So again a total change of scenario out there.
And what's the period that defines long-term? Is it beyond 1 year? Is that still the standard?
The period continues to be unaltered.
And the rate is now at what? Is a flat rate between both short-term and long-term. So it's still 10%, or what is it? Mr. Kanabar, is the rate the same?
The rate for capital gains tax is 10%, that's right.
All right. Porus, the question I'd like to, sort of probe with you a little further is all the changes that will take place in non-resident taxation, as both you and Mr. Kanabar were pointing out to, and you did point out to the definition of resident companies. Can you go into a little bit more detail on what this will mean, both for MNCs operating in India and what this will mean for, let's say, some of the high-profile cases that we have? Like, for instance, will it impact M&A transactions, as we've seen, in the case of Vodafone?
Well, firstly, today you have a situation under the current law that a company can be resident in India if its full control and management is in India. Now that is extremely rare, so having one board meeting doesn't make it resident in India. That is to be changed to any. Now therefore it means that as long as any part of the control and management is in India, it becomes a resident in India, exposing it to worldwide corporate taxation. Therefore, significantly risking the exposure of those who are coming into India, and certainly increasing the territorial reach of the Income Tax Act. As I said, this is a policy issue, and I think it needs to be further debated. From the other aspects, there are certain subtle amendments in Section 9, which include the indirect transfer of capital assets. Yes, I think perhaps it's a subtle way of trying to ensure that indirect income arising from transfer of capital assets situated in India becomes taxable. Government obviously feels a bit aggrieved by what's happened in the past, and I think they are putting in those provisions. Taking off from what Dinesh said, the treaty rules, I think that's an extremely large policy decision, and to have a situation where domestic law can override treaties is something we need to debate and discuss. I think it's not conducive to international investments, and you must respect a treaty irrespective of at what point in time it is signed. The few other things, advanced pricing arrangements come in for a period of 5 years with board approval, etc., etc. So certainly consistency and clarity, and will help the corporates in having transfer pricing issues. But you must remember that once you become a resident in India, you don't have a transfer pricing problem, because all your income becomes taxable here, and you don't need to do transfer price between a non-resident and Indian taxation.
All right. Mr. Kanabar, would you like to add anything to that, or should I move on to the question of what you see missing, in this new code, however commendable the effort by the government is?
Just a couple of comments, sure. Adding on to what Porus mentioned regarding control and management. You have a situation where today China and India are regarded as some of the most important places where global business is being expanded. So you do have actual instances where global boards meet in India to demonstrate their commitment to this country. Nobody will now ever want to do that. And I can tell you there are replete examples where global boards do come to India and hold a single board meeting, and that can now expose them to taxation. More important, one would like to see what does this do to the entire concept of BPO and outsourcing which happens out here, and can the tax office go ahead and allege that any part of the management of a foreign company exists in India because there are certain decisions which are being taken at the level of BPO operations. I thought this is something which calls, as Porus rightly said, for a debate, and in this era of globalization, I do not know whether this is a forward-looking step. The treaty override provision. So are we now really looking at a situation where for a treaty to grant a benefit to a non-resident, all tax treaties will have to be renegotiated so that they can prevail over the code, because the code is latest and we have currently 75 odd treaties which India has, and therefore now the code will override the tax treaty. Again, I do not know whether a lot of thought process has gone into this entire provision.